Okay, so I'm Julia Copley, Head of Operations at the MGAA, and I'd like to welcome you to our webinar this afternoon, which is being delivered by Sedgwick. Before I introduce our presenter, I'd just like to run through a few housekeeping points, if I may. Please ensure your microphone and your camera is off. And if you'd like to ask a question, please can I divert you to the chat button at the bottom of your screen where you can submit your questions. These will be answered during the Q&A session at the end of the presentation. And if we do run out of time, our presenter will be happy to answer any questions post-event. This presentation is accredited for CPD points if it's relevant to your ongoing professional development. And the video will be available on our website and uploaded to our MGAA channel, YouTube channel, post-event. We will also make the slide deck available to you post-event. Please take time to respond to our SurveyMonkey survey for your feedback on the event. It does truly enable us to bring you the best quality events. So today's webinar, Future-Proofing Your Risk to Fraud Using AI, is brought to you by Sedgwick, and our presenter today is Ian Carman, Director, Investigation Services. Ian started his insurance career in 1997 with RSA as a claims handler and then a loss adjuster before entering the specialist area of claims investigation. Ian was head of property claims within the Cotswold Group before joining Sedgwick in January 2021. Ian is revolutionising Sedgwick's approach to fraud alongside overseeing the implementation of market-leading automated counter-fraud technology. Ian has introduced intelligence, fraud assessment and data teams to improve client insight and counter-fraud performance. He is responsible for Sedgwick's counter-fraud strategy and is developing dynamic, agile solutions that harness the combined power of technology and human expertise to effectively tackle the ever-evolving fraud challenges Sedgwick's clients face. So Ian, if I might hand over to you.
Of course, thank you. It's a very grand introduction. Thank you for that. It made me feel special. And thank you very much for the opportunity and for everyone joining me today. The done thing with these sorts of webinar sessions is normally to have a bit of a corporate digital background, isn't it? I'm afraid the combination of my bald head and the light above my head means that digital Zoom backgrounds never work well, sort of blend into the background. So you've got an insight into my home office. You see at the back there, I'm into restoring classic tractors. That's one of my hobbies. And it got me thinking that tractors are a little bit like fraud investigation, and bear with me here while I explain. So tractors are essential, aren't they? We all recognise that they help farmers produce the food that kind of keeps us all fed and alive. But fraud detection and strong indemnity control keeps us in the insurance world in business. And we're able to keep the cost of insurance competitive for our end customers. If we let fraud run rife, of course, cost of premiums go up. It's much harder for us to do business, industry, society suffers. So the cost-effective insurance protection is important to society, enables us to go about our daily lives. So it's for that reason I say tractors and fraud detection are essential. They both may be essential, but tractors are incredibly slow. And none of us want to be stuck behind one of those on a road. And speaking to somebody that lives in rural Kent, it's harvest time at the moment and it's tractor chaos on the roads at the moment. So whilst we all recognise the importance of tractors, it doesn't mean we want every journey to be delayed by one. We want them to be in the field doing their thing without impacting our daily lives too much. Or in the case of fraud detection, MGAs, brokers, insurers, and ultimately consumers rightly expect robust fraud detection without the claims journey being unnecessarily delayed. So there's some parallels there between tractors and fraud investigation. I'll talk about tractor fraud a bit later on. And like a slow road journey, a slow or cumbersome claims journey is a real turn-off. It's a barrier to you guys doing business, but it's incredibly important. And of course, it's a regulatory requirement, and none of us therefore should forget about it or ignore it in the pursuit of a great customer experience. And it's certainly not something we should forget about in terms of profitability or ultimately the end game of keeping insurance premiums competitive for all of our benefit. So let me tackle the problem, solve the problem of catching the vast majority of the bad guys without all of our customers being stuck behind that fraud tractor I spoke about, the delayed journey. Today I'll cover off the importance of a strong fraud strategy for you as a business and the role that counter-fraud technology can play in your financial success as a business. And the industry often think about fraud as a bit of a claims issue and a claims problem, but enriching underwriting data and claims fraud data and investing time in a fraud strategy directly translates into underwriting profitability for obvious reasons. We'll take a look at the impact to your bottom line on doing a little, doing something, or doing a lot in the fraud detection and prevention space. And I'll also talk to you about how artificial intelligence technology, blended with the very best human expertise, can really move the dial on seamless fraud detection and avoid that fraud tractor that I'll talk about today. First, I've got a couple of questions for you, if you don't mind, in the spirit of interactivity. Hopefully these will be displayed on a poll. If we could just have the next slide. Great. And the first question is, does your business or your TPA have a documented fraud strategy? Really simple, not too taxing, yes or no. So give you a few seconds to hit the button. I hope we should have the results shortly. Great, so we've got 83% as a yes, no 17%. And we're coming to talk about the importance of the fraud strategy. It's really pleasing to see the vast majority of businesses represented on this webinar have got a fraud strategy. It's really important. We'll get into some of the detail of that and how detailed and joined up with TPA, your TPA partner that may be. Next question I've got for you is, how involved are you or your business in setting the fraud strategy? So it might be something that you give to your TPA to manage. It might be something actually you drive and you tell the TPA how to manage. Just interested in levels of sort of involvement, really. Okay, it's interesting. That sort of mirrors broadly, but my perception, to be fair. So 60% of people on this call not involved, 20% involved a little, 20% involved a lot. So I guess I'm probably not talking too much to those that are involved a lot. Hopefully there's a little bit that you can get from today, but certainly those that are not involved in it at all. And that might be because your role is not to do with that, I accept that. But we'll talk about the importance of it. And for me, the importance of MGAs being involved in a TPA fraud strategy. So if we could have the next slide, please, Julia. Moving on to, sorry, Julia, I think can we just go on to the following slide? I think they become mixed up somehow. Perfect, thank you. This looks at really the impact. This is a scheme, it's a mid-sized commercial property MGA scheme. Annual indemnity spend on the scheme is just shy of £111 million. Average claims cost is £12,300. And the scheme sees 9,000 claims a year. So it's a sizable scheme. It's a large type scheme. On the right-hand side of that table there, on the right-hand side in the table, we see 4 different TPAs. Anonymous, TPA 1, 2, 3, and 4. In the middle of the box is the percentage of claims per year that TPA handles that result in fraud saving. So identified fraud, proven fraud. And on the far right of that box are the associated savings that flow from those detection percentages. So with TPA1 saving the MGA, the carrier, 332,000 a year, all the way down to TPA4 that's really outperforming the commercial property benchmark that the API set. They're delivering 2.2 million quid worth of fraud saving each year. And you see the difference between the two. And the average, in our experience at least, TPA1 and TPA2 are fairly common in the marketplace. That seems to be where the sort of performance sit. And the average isn't horrific, and I'm not here to knock TPAs, but taking TPA1 and TPA2 as an example, they identify some fraud, arguably enough to keep the MGA and the carrier happy, but they don't actively drive fraud performance. And you can really see the effects of that in terms of missed opportunity in the right-hand column in cold, hard cash terms. TPA3 and TPA4 routinely outperform the market. And that may be because, in terms of fraud strategy, they've got a clear fraud strategy that's had significant input from the MGA in terms of their own fraud risk appetite, or they may be at the forefront of new technology-enabled identification methods, or they're just really good at fraud engagement and training right across their business. But you can definitely see the difference between somebody that is fairly passive when it comes to fraud detection and fraud strategy and those that are on the front foot with it. And looking at the worst performing TPA compared with the best performing TPA, you can see the significance on lost profitability and therefore lost competitive edge in terms of scheme arrangements, just shy of £2 million. I just wanted to highlight that and start off with that scheme because clearly £2 million buys an awful lot of tractors. It's much more, it's pure profit, isn't it? So at this point, I've got a third question for you, and I promise this is the last question. And that is, what's your perception of your TPA's current fraud performance? Okay, let's wait for the results. Okay, that's interesting. So that for me, I'm glad there's no terribles. That's good, and that speaks to, I think, the slide we've got displayed here. We haven't got anybody that's really that 2% that's market leading necessarily, but we've got lots in the middle. Average could do a bit more, could be a bit better, and that mirrors my understanding, my experience of the sort of TPA market. So that's interesting. Thank you for your input with that. If we can just go back a slide, I think it's Julia. Apologies, I got mixed up. There we go. I'd like us to think about some of the wider implications on an MGA or a TPA of not placing enough importance on good fraud detection. So in most areas of the market, we're experiencing tougher market conditions. It's hardening. I don't need to tell you about that. You're much closer to that detail than I am. And one way of navigating your way through that is by demonstrating strong and effective controls and through partnering with a TPA that really takes responsibility for driving that fraud performance. So the 2%, TPA 4 rather than the 0.3%. And that TPA places equal importance on people, data and process. And for me, it's a bit of it's a three-legged stool. If you remove one of those things from good fraud detection, it falls over. You can't have a strategy that's predicated purely on data, and you can't have one that's predicated purely on people. You've got to have two big pillars, all about by some really, really good processes that sit in the middle and join the dots. So those three things are really, really important. And I guess the purpose of the day is really sort of challenge your own thinking on that. Is your TPA doing enough in that space? Do they have that joined up? And so the size of the prize on that one scheme alone, £2 million. And providing your capacity providers in this hardening market with a reassurance of robust, innovative, cost-effective controls, no doubt flows into those capacity discussions and makes doing business a bit easier for you guys. Some TPAs talk a good game about fraud, but when you scratch beneath the surface in terms of what actually exists in terms of counter-fraud controls, they may have a counter-fraud team or access to a fraud specialist or even refer fraud back to the carrier for handling. But they're at the end of the process, and sometimes we as an industry and sometimes the business I work for is a bit guilty of this, that we think about fraud as the fraud investigators. Actually, it's two steps behind that. It's about the handlers, it's about the adjusters and good identification. And that's the role that a TPA plays. And when we examine sort of TPAs closely, and I look at our own TPA business, most are still using traditional key fraud indicators and handler training and fraud awareness as the primary means of identifying fraud. And in 2021, there's got to be a better way of doing things. MGAs, rightly viewed as nimble, agile, technology driven. How often are you let down by lack of kind of real granular claims insight? I'm talking about a layer or three down from peril and reserve trends here. And to bring that point to life a little bit, we work with MGA that's written into the household policy as a freezer food benefit. So in simple terms, if you suffer a freezer food loss, the £300 policy limit or benefit kicks in automatically, irrespective of the cost of the actual loss. You might have only lost £100 worth of food, but they pay you, as a matter of course, a £300 benefit. So the benefit of that is instead of claims handlers spending time validating how many lobsters, pieces of T-bone steak were or were not in the freezer at the time of failure, the policy simply pays that freezer food sum insured at the point of notification. And whilst that may sound like a small benefit, it's groundbreaking and not something that the market has tried before. From a customer experience perspective, the policyholders get a warm, kind of fuzzy, good feel factor when they don't have to worry about photographing rotten food, keeping hold of it, or quibbling over things like partial usage. That MGA can and does market that as a unique selling point, as a benefit to sell more policies. And from an operation handling point of view, it's efficient and arguably we can plug that straight into a straight-through processing model. So it's sort of win-win. But you probably know from where this is going. As a fraud practitioner, for me, the thought of handing over even a relatively small sum of money without detailed validation makes me nervous. But I recognise life's not all about me and my worries. Because that benefit's potentially open to abuse, firstly from opportunistic fraudsters, so your average Joe Blogg's householder that could exploit that benefit annually and essentially receive a free policy, let's face it. The second is, and probably more concerning, is from organised fraudsters who may well see that as an easy target. They could target our MGA to insert vast numbers of false policies en masse, and we know that this goes on, take out a policy for a month, cancel it, make the claim, receive £300, and all of a sudden they've realised this was 30-to-1 return on investment for every policy they've set up fraudulently. So there are some risks, and I appreciate we're not talking really big ticket stuff here, but a lot of £300 quickly adds up when we're dealing with very small margins in this particular space. So the way that we tackle that potential abuse of benefit is through near real-time insight and analysis managed by us as a TPA. And the fraud strategy we've built hand in hand with the MGA recognises that risk and documents how we manage that risk. So at claims level, our systems and technology analyse every single freezer food claim for that fraud risk using a series of algorithms that are specific to suspect freezer food fraud cases. So things like the demographic, policy, environmental factors associated with those known fraudsters. And if the case does not attract our attention, it's paid and it's paid quickly, and the MGA gets to fulfil its promise, its marketing promise. If it does, a human steps further into the process very quickly to validate that claim and take whatever steps are necessary. And where we step in, 57% of claims are just not pursued and result in a very non-contentious walkaway. So the MGA or the carrier has not burnt a load of investigation cost, and it's a really effective strategy. We know what the risk is, we know how we mitigate it, we know how we manage and monitor it. So that's about working hand in hand with the MGA on the minutiae, on the detail, to make sure that they can carry on benefiting from that marketing effort. At a more macro level, we're continually updating the MGA on the actual exposure, so not just notifications. So they're able to continue to market the benefit, safe in the knowledge they're not being exposed by opportunistic or exposed to the targeting efforts from organised fraudsters. The second they feel they've become exposed, they're prepared to steer away from that benefit and write it out of their policies, recognising it was groundbreaking to start with, but there are some potential risks. And if that risk materialises, they've got the insight to steer away from it. So in summary, this goes back to MGAs having input into fraud strategy. Having that joined up fraud strategy that deals with a micro rather than just a high level, we will detect fraud type statement, allows that MGA to take more risks in the marketplace. They can deliver genuine market USPs, but at the same time remain reassured through that near real-time data that we provide them that they're not being exposed. They don't need to wait for 3 months or 6 months worth of trend data and analysis in the traditional way to realise that they're caught cold. They can do that within days and weeks. And that's because we're alive to the risks and we're working on the nitty-gritty in partnership with that TPA. Moving on, fraud detection should never be passive. So here at Sedgwick, my leadership team includes our operational directors that manage day-to-day fraud investigation functions across motor, home, TPA, commercial. But it also includes a head of fraud data and insight that provide our clients with that granular, actionable insight that I spoke about, but also a head of fraud engagement that's solely responsible for making sure that our TPA and our adjusting colleagues are doing what they should be doing in terms of fraud identification. It's something that is the voice of our client in our business. And the reason I mention that is that a well-developed fraud strategy is much more than some words on a PDF document. It's much more than an appetite or an ambition. It should be an organic document, but it's about detailing the risks in micro detail, how those risks are managed, and more importantly, aligning skilled and dedicated resources to take responsibility for managing those risks day to day. So a fraud strategy that's got that level of detail is key, and that should be joined up between MGA and TPA. The final bullet on this section of this slide is a saying that served me well throughout my career in fraud investigation. Fraud doesn't just come in with the milk, or more specifically, fraud referrals don't just come in with the milk. You have to actively seek it out at a strategic sort of macro. So what are we writing? What are the risks around that? but then at operational granular level as well. What does that freezer food claim look like? And you've got to, as part of that journey, listen very carefully to the client's fraud risk appetite and translate that into action. So rather than being generic, yeah, of course we tackle fraud, we've got a shiny fraud team. Translate that into meaningful action and ownership and accountability, just as in the freezer food piece that I talked about. However, when we engage with clients, what comes through loud and clear as a common theme is, it won't be any surprise, we don't want a fraud tractor. Don't slow down the process. Don't involve our honest customers in the process. And I agree wholeheartedly with that. And that's the part that technology plays. So in 2020, last year, just before I joined the business, we set about challenging our own thinking on fraud detection performance and really whether or not our detection strategy represented a fraud tractor or was it a fraud Ferrari. So we sort of did a bit of navel gazing. We knew we had already had a strong counter-fraud function, but as I said before, that's great, but it's at the end of the process. How good are we at detecting fraud in our TPA operations, our commercial and home operations and motor operations? I think we recognised that we could be better at identifying fraud risk for our clients, and we saw an opportunity to take our performance from good to great in the identification piece. And technology plays a pivotal role in countering organised and opportunistic fraudsters. I mean, in simple terms, the very best technology can compute vast quantities of data and spot the anomalies in a way that humans can't. So if we think about that in example terms, to bring it to life a little, if you imagine you've got a claims handler that's dealing with, let's say, 10 cases a day, how does that particular individual claims handler spot that the loss list they're reading, actually, we saw in our business 18 months ago for a different policyholder, a different address on a different claim? It's just impossible. There's no way of doing that. Humans, we can't trawl through the thousands of bits of information that we receive a day. Well, that's where technology steps in. So the claims handler can spot actually from a behavioural point of view, there's an issue here, but that big data perspective, they're blind. Technology can, and the ability to compute vast quantities of structured and unstructured data, apply rules, machine learning principles and fraud detection algorithms are a crucial weapon in 2021 fraud detection. And without that, you're sort of scrabbling around in the dark on the bits that you can't see. You'll never get to it. If we look at how much of the industry is, and up until very recently, indeed our organisation, the business that I work for, we were reliant on kind of key fraud, behavioural, human intuition, and key fraud risk indicators that really haven't moved on much since the 1980s. So it's time to turn the dial in the claims management space on technology. And it pains me to say that, but it's true. Generally speaking, fraudsters are always one step ahead of us. I don't like to say that, but that's the cold hard reality. And I always think of it as a kind of game of whack-a-mole, the game that you play down at the seaside. One mole pops up, you whack it, another one pops up somewhere else in another hole. It's the same with fraud. When you successfully tackle one fraud type, those fraudsters learn your detection methods and move on to the next fraud MO. We see this all around the industry, and there's some recurring themes, but generally people are moving around. And in the fraud cycle, the industry at the moment kind of takes 6 or 12 months behind the emergent trend before we're onto it. And then we sort of slowly move to react. And we share the message with adjusters, we share it with our clients and carriers. Having access to powerful analytical data with artificial intelligence allows us to see very quickly, in near real time, where those fraudsters have moved on to and where those risks are emerging in near real time. Of course, that only works with human understanding. So, our technology could say you've seen 12 claims, flood claims in that street. Well, of course you have. That's because there's been a flood event. So you need to have the rules that are sophisticated and intelligent. You also need humans that sit behind it to apply that context. And that's why we've got teams of analysts that work through potential fraud scenarios and alert our client base so that their underwriting stance, importantly for you guys, but also the claims control philosophies can be adapted in real time. And to, sorry, bear with me a second. To demonstrate what I'm talking about, I'm aware of one client that we work closely with, a long-standing client of ours. They were being targeted by organised fraudsters and they were being confronted with a vast number of claims for the accidental loss of high-value 14-carat kind of blingy gold chains in and around North East London. This was a couple of years ago. And it took that particular insurer around 3 months to spot the trend, purely from an analytical point of view. Hang on a minute, we've been a little bit exposed here. We've seen more than we normally saw. It took them about 3 months to realise that. They then spent 2 to 3 months, quite correctly, quite legitimately, investigating those cases to understand actually this is the MO, this is the fraud, and these are linked. So by the time we're really educated on that fraud and that emerging trend, we're 6 months down the line. And some of the key attractors that were involved in that was a particular tube station in London, in East London, a particular jewellers. Claims were all made 31 days after inception by a male demographic in the mid-20s. So for those that of you that are on the call that sort of are around fraud, that's gold dust, that's brilliant. From a data perspective, there's so much to go at to flag through an automated detection system or even a manual detection system. But of course, that's in retrospect and that's reactive. And that'll only work once you've alerted the tool to those particular key attractors. So you've got to manually plumb in the tube station and the jewellers. Thereafter, of course, the tool will detect the fraud. But with the technology we've chosen, which I'll talk about in a bit more detail, which is shift technology, the tool automatically understands what our average exposure is to those key attractors by hour, by day, by month, by year. So in that particular scenario, we may be used to seeing, let's say, 1 claim per month in that postcode region for 14 carat gold chains. The very second that any of those key attractors spike in volume, the system alerts us and we can immediately investigate. So practical example, we're used to seeing 1 claim per month with that particular, those key attractors sitting around it. If we suddenly start to see 3 a week, on that third claim, we're immediately notified to say, hang on a minute, the exposure's out of kilter here, something's wrong. What does that mean for MGAs and carriers? That's great for me and my fraud staff and teams, but what does that mean for MGAs and carriers? Well, it means we're able to alert you to engage emerging trends as they happen. So allowing you to adapt your underwriting philosophy, exclude certain postcode areas, increase rates on specified items, 14 carat gold chains in this instance. And we can really get into the detail very quickly. So on that first week, when it's flagged, we'll validate that, we'll have a look at that, we'll look at some of the trends that sit around it from a human perspective. We can quickly say to you, actually, you might want to consider your rates, or you might want to consider stepping away from the jewellery commodity. But not just the jewellery commodity, because that's a massive market. Do you want to write yourself out of that straight away? Probably not. We can be really detailed and say the risk is 14 carat gold in this particular postcode. So you can easily tweak your rating model, your risk appetite very, very quickly before you become exposed. So we've moved the dial from, we'll tell you in 6 months' time when there's a trend, because we've seen a load of claims and we're worried about them, to actually, this is the start of a trend. And from an underwriting perspective, and being nimble and agile, that's really, really important. And the power of our data, and the sort of relatively unique position we've got, is that it's cross-client, it's cross-industry. So it might be that you as a particular business don't write too much specified jewellery insurance. And our alerts, it can be any sort of alert, but our alert in this particular example would maybe prevent you from entering that market, or just dipping your toe rather than going fully into that market. Equally, it might be that actually you write a lot of specialist jewellery schemes, and that industry-wide claims exposure that you may not have seen yet, but we're starting to see across our client base, we can allow you to see what's happening. And you can quickly adapt your pricing model by the minutiae, by the postcode, by the age profile, by the 14 carat, by the sub-commodity. And we call it seeing around corners. And if you're a Sedgwick client, you'll see much more of that from us in 2022 as the technology and our data science teams really start to evolve. So we're quite excited by it. It's good stuff. And we think there's a lot of benefit, not just in claims, but for underwriting guys, particularly in the MGA space, where you can, in a way that carriers and insurers can't act quickly and swiftly, you guys can. So technology we've invested in not only has us to identify that fraud, but the emerging threats. And when you combine that with your agility, as I said, I think it's quite a powerful recipe. And going back to my whack-a-mole example, simply relying on the key fraud indicators of old, they still play a part, of course they do. And that human intuition alone is a little bit like trying to hit one of the moles with both arms tied behind your back. It's often too little, too late. And the market are getting better at sharing information with clients, so the investigation market. But more often like it's too little, too late. You know, it's kind of post-trend. It's already happened, or everybody's onto it already. So this really moves the dial in terms of what's happening next. So you might question, we're very strong on fraud, all that sort of stuff. Does having that focus on fraud and this sophisticated counter-fraud technology mean that we just drag our net wide, accuse every other policyholder of fraud just to get those impressive fraud statistics by hook or by crook? Definitely not. I mean, our own studies show that there's a 5-fold increase in complaints from honest policyholders that are caught up inadvertently in a fraud investigation. That's not rocket science, and we probably could have saved a few quid on a data scientist telling us that, because we all know that. But it's a really important metric, and one that really focuses minds on ensuring that only high-risk policyholders get routed into the fraud process. We don't want to see anybody else. My guys want to investigate fraud. They don't want to investigate innocent people. Complaints aren't good for us. They're not good for your business or anybody else involved. Particularly in tough times in terms of retention, we've got to deliver the promise. We don't want to annoy customers in the process. So, fine-tuning and eliminating false positives is about ensuring the fraud scenarios that are built into the technology are continually fine-tuned. The technology we've invested in has got machine learning capabilities, so it knows what good and bad looks like, and it continually evolves. But also the human expertise and oversight really helps with that. Excuse me. So, to ensure an added layer of protection for the honest customer, every single automated alert is reviewed by a human to ensure that context, rigor, tests of proportionality are properly applied before we jump in with both feet and start accusing people of fraud. Well, that's what we do, but it's really proportionate. At an operational management level, tracking how many suspect cases do not end up being investigated is just as important as tracking those cases that do, to make sure you're doing the right thing and treating the customer fairly. That goes hand in hand with strong fraud detection. So the takeaway from this for your own TPA could well be, it's great that you detect 1% of fraud. How many people are going through that process to get to that 1%? If it's 20%, they're doing something wrong. If it's 2 or 3%, they might be somewhere nearer the mark. So it's about making sure you're looking at not just the output, but what goes in to get to that output. From a treating the customer fairly point of view and doing the right thing. Before I go on to talk a little bit more detail about some of the mechanics of Shift, I should say this is technology that sets us apart, and this was one of the things we wanted to do. And there's a good reason for that. This is primarily insurer technology that we're deploying here. When an insurer deploys this tech, their route to investment return is pretty linear. So they invest a sum of money, the insurer, they detect more fraud, they then reap the benefit of that reduced indemnity spend. That's pretty simple. For us, that earn our kind of money from fees, the investment costs are largely the same, but the business case is not so straightforward. So we see this as a genuine market differentiator, certainly in the claims space, but also in the underwriting and MGA space, which is hopefully what I'm talking to you guys about today, and hopefully it's of interest, because there's a real ability to tap into some of that claims fraud data in order to use it for you guys to turn on the penny in terms of your risk appetite. So it's completely free of charge as well. Sedgwick clients, it's included in every single claim we do without charge. So if I could have the next slide, please. And the one after that. Okay, so the name of the business that we've invested a significant sum of money with is Shift, and the product is called Shift Force, and this is their fraud detection solution. It's a powerful AI-powered solution that identifies fraud perpetrated at 2 levels. So one is individual level. So what does a fraudulent claim look like and smell like? What are the key attractors from a data point of view that sit around that we can drag out and say, that looks like fraud. We've got some experience of that being fraud in the past. That could be at demographic level, it could be at claim circumstance level, or historic experience level. But it also, this is where it's most powerful, at network level. So it identifies current and historic links between fraudulent entities. And if we think of, in the motor space, crash for cash fraud, that's rarely perpetrated by just one individual or a couple of people. There don't tend to be opportunistic fraudsters in that space. It tends to be a network of tens of people, organisations, accident management firms, solicitors, engineers, repairers, as well as the individuals themselves involved in it. And successfully cracking those cases relies on joining the dots in a network fashion. Who's talking to who? Have they interacted before? Are the parties known to each other? Should they be known to each other? Can that be done manually? Well, of course it can. Yeah, I mean, days gone by, that's how the industry did it. Lots of charts and lines and bits of string on big whiteboards. So it can be done manually. But of course, I want to know that that fraudulent claim is fraudulent on day 1 or day 2. I don't want to know about it on day 20 when we've got a sniff and we've spent lots of time and lots of expense and resource getting to that. So things like Shift Technology and other providers on the market bring this data together and display that network to us very quickly. So it's not a fraud tractor, it's quick, we're onto it, we're reducing costs. And I often get asked, does this sort of technology prove fraud? Is it a silver bullet? And my answer is always no. It's another tool in our fraud investigation and fraud detection toolkit that alerts us to the risk, albeit in a very sophisticated way. It's always for suitably qualified analysts and investigators to firstly ratify A, the outputs are correct, because there is always a risk of false positives, being transparent. That's the part that humans play. And secondly, we've got to go on to actually evidence the fraud in exactly the same way we've done for many, many years, to the required standards, to the required legislation. This technology will not land a file on Insurance Fraud Bureau's desk to say, please have a look at this, or a police force's desk to say, please prosecute this fraudster. That's the work for humans, so it won't replace humans in time to come. It just makes us more effective. And in being more effective and more efficient, we naturally hope that flows through to us being more competitive in terms of investigation fees. So we're driving down not only indemnity costs, but driving down your expense base as well. So just moving on to the slide here, we can see it's how the technology works. And I'll never do this justice, if I'm honest. I'm not a shift salesperson, so I will try my very best to explain how this works, but it's very, very sophisticated piece of technology. The claims, we Sedgwick see 300,000 claims a year, or just shy of 300,000 claims. Wide-ranging client demographic, motor, liability, home, commercial, cyber, construction, marine. Every one of those claims is managed right across our client base on one single platform. And Shift Technology, the solution that we bought, works right across that data set. And if you imagine how many individual pieces of data and documents are associated with just one claim, you get a flavour of how powerful that data can potentially be if it's harnessed and if it's used properly. So in terms of how it all works, how it hangs together, you see on the receiver map, the bottom left of that slide, what goes into the mix. So claims, policy information, all the bits of data that make up a claim. So policyholder name, address, business name, company number, you name it, registration number, it goes into the mix as a piece of data. Invoices, photographs, the metadata that are associated with those invoices and photographs and documents, but also the text as well. Loss adjuster reports, expert reports, claim forms, we're going back in time. All of the CNFs, all those sorts of things go into the mix, and Shift is reviewing. On the second box there, pre-processing, it essentially strips the thing that makes all of those bits of data hang together, of course, is the claim number. That's the commonality. It all hangs off of the claim number. What Shift Technology does is say, right, okay, that's lovely that they all hang together. We're going to deconstruct that. So Fred Bloggs that made a claim over here, at this address, at the email address, they are separate bits of data. We're going to put them into a data soup. And the technology, and again, I'm not doing it justice, comes along, gives it a very big stir, and says what commonalities exist within that pool of data. So we've got Mr. Bloggs over here who made a household claim. We've got Mr. Bloggs over here who made a motor claim. They're two different Mr. Bloggs, using two different names, but actually the bank account they're using that we're going to pay the claim with is common. We think those two Mr. Bloggs are the same. We think it's something that's potentially changed their ID. So you can see how powerful that would be with something like a stage motor accident, where people, once they're detected, or they're trying to avoid detection, they'll change name, addresses, postcode, emails. Generally, one or two bits of data are common. And this technology works right across our data lake and our data estate to spot the commonalities. It will then make social connections and extract data from unstructured sources. So this is really, really powerful. If we've got, as I mentioned earlier, the example of the tube station, we can quickly plug in, there's one or two ways this will work. The tool, because it's artificial intelligence based, will say, hang on a minute, we've seen that tube station, or reference that in a file note, in a document, in an invoice, whatever it might be, 3 or 4 times. We're concerned by that. But we can also tell Shift. We can also say, we're concerned about that tube station. Tell me when that pops up. We're concerned by this particular claim type. Tell me when that pops up. And again, that can be quite powerful for you guys. If there's something you're particularly interested in, tell us. We can pull that out of our data and analyze that pretty quickly. So it does that. We then blend in external data. So we are affiliate members of the Insurance Fraud Bureau. We receive a data feed from them once a week with known insurance fraudsters and entity information. It washes against that. So not only do we know these individuals, does the industry know these individuals, or we confirm fraudsters. Things like government records, so it's company's house, it's closed source databases, previous claims history. So for some clients, we'll add in Q to the mix as well, so we get a really rounded picture of industry-wide data. The aerial imagery quite excites me. So if we get a storm claim or a flood claim, it locates that property in Google Maps, automatically displays that map for us. Street view as well, so if we want to look at the state of the roof, pre-loss, post-loss, whatever it might be, we can zoom in very quickly, and Shift technology does that for us automatically. So it's very quite powerful, and it makes us more efficient. And efficiency, with efficiency of course comes competitive fees. Final thing it does here before it displays an alert for us is looks up hundreds, I think about 230 odd fraud scenarios across liability, home, commercial, motor, etc. And it knows what fraud looks like, it knows what it smells like from a data perspective, and it will quickly detect commonalities in that data where it says actually this is high risk in terms of fraud, and that could be from something we've told it, so that tube station. Paint spillage is an obvious one, we could rate that as high risk, but also because of the machine learning aspects, what we've done in the past. So this tool's got 6 years worth of our historic data. If we've handled 50 paint spillages and we've not paid 45 of them because they've been fraud, guess what? It's going to rate very highly automatically. It will drag that through for us to review. So it's quite sophisticated. The final thing it does, of course, is alert us and the user interface, not our investigation teams. They'll analyse it. You've got that human oversight. This tool doesn't make any decisions. The humans make the decision. Gives us very straightforward investigation guidelines. Not that we need them necessarily, but it points us in the right direction, so we're not interrogating and questioning the system, we're interrogating and questioning the claim, so our time is better focused elsewhere. Could I have the next slide, please? So just to whiz through this, just sort of gives a little bit more detail about how it all hangs together. Claims data set, from push the button again, some animation. We've got all the historic data from our handling platforms, ongoing data, daily feed refreshes. So as soon as the document hits our system, it gets uploaded to Shift and it'll analyse that. You just click again. Those individual claim records, click again. The claims data set into individual is then broken down in those individual entities. So the blue might be contact information, name, email address. The green might be claims data. So individual bits of entity data that make up that claim. Next slide. And they're ingested into the system and scored using AI modeling, so with the reference I talked about before. Have we seen this type of claim before? What were the outcomes? So the machine is always learning. Next slide, please. And again, sorry, I think this one's duplicated. And again. And it's looking for those connections. So the commonalities in that pool of data, as I referenced it earlier, it's somebody with a big wooden spoon stirring the data soup. It highlights the concerns of investigation. So right in the middle, you might have your fraudster, and these are all the claims and fraud links he's associated to. Next slide. Then I'm told actually this is out of date. They've just released a new version, so this slide is slightly out of date, I'm afraid. But this gives us details about the claim, gives us details on from a geolocation point of view on a map, so we can see what's our exposure in that area. So even in a non-fraud space, we can quickly see how exposed are we in a particular event, so a flood event or a storm event. We can zoom in and out of that particular area right across the UK and see where our claims are and what's happening. Particularly useful for things like stage motor accidents, where we can see it's all going on in this particular roundabout, and from an emerging threat point of view, emerging trend, we can feed that data back to you real time if we start to see geography concerns. Next slide, please. And again, this just brings what it looks like in terms of making links between individuals and parties for us. Next slide, please. Okay, just to really demonstrate the power of the technology, quite excited by this, sadly, but these are two different documents that are taken, I think, about 18 months apart. They were supplied on two different claims, clearly two different images. They're not PDF, they're not Word documents, they are images of paper copies. And what you can see here clearly is that the text looks broadly similar. I appreciate it's a little bit blurry on the screen so you can't read it, but the text is identical. They're 18 months apart, different metadata, so even the metadata is not common. It will make up the properties of the document. Different file names, see different angles, What the technology has been able to do is read the document. Even though it's not a document, it's an image. It's with the text. It's looked at the shape and the formation. And it's immediately flagged, hang on a minute, you've seen this before. Different claim, different carrier, different policyholder. But this document's doing the rounds. So you can imagine how powerful this is a loss list, but imagine that across a valuation or a dodgy document that's doing the rounds. Very, very powerful. We're quite excited by what that will do. Next slide, please. I may need to click so one more time. So you might say, great, we're an MGA, we don't handle claims ourselves, we outsource that to a TPA. What does that mean for me? So just in summary, the next one more click. Claims space, business assurance. So fraud risks are mitigated at zero cost and without impact to the honest customer. So from a retention point of view, us deploying this type of technology is really, really important. We're only putting people in the fraud journey that we're 110% satisfied should be in the fraud journey. And the system, alongside our humans, works hard to eliminate those false positives. So you're not getting noise. Noise is not going to carry about the volume of complaints that your TPA is producing. Naturally improved indemnity spend controls, better loss ratios, and I know you guys will know what that means for you in terms of commission arrangements and whatnot, but it's a really strong protection in terms of indemnity. Reduce fee spend through targeted investigation effort. I've referenced that a couple of times. Actually, if we're better and more efficient and the fraud is more directed towards us, of course, it doesn't take us long. We don't need to trek up and down the M1 and have a chap in a four-one day with a briefcase spending hours and hours on the road. Actually, the fraud is in front of us. Yes, we're still investigating properly and thoroughly, but we can be more efficient because the technology is pinpointing where we need to be. That flows through to reduce fee spend. Customer retention I've already mentioned and the importance of that in this market. Next section, please. So in terms of underwriting new business, better controls, associate financial performance, and that provides a platform for capacity. Hopefully that enables you to have robust discussions with your carriers to say, give us a bit more capacity, we've got this under control, we've got this technology, and actually the bookings or the scheme is performing well. Provides that platform for underwriting creativity that I spoke about. So the MGA that we referenced, because we worked in tandem with them, worked closely with them to say, well, you can do that. From my point of view, that's risky. You might be targeted, but let's work together to build a strategy that tackles that particular issue in the minutiae, not just at a big data point of view, and let's just see what happens in 6 months. Let's look at this in real time. Let's work together and talk to each other about how you can be more creative. And they have an appetite to do it, and actually we're quite happy to pull away if some of the risks that I spoke about materialise, but they're under control and managed. That real-time insight and analysis, I think, is really, really important, and it moves us from where we are currently, which is we'll kind of get onto a trend, we'll investigate a lot of claims, and then we'll tell you that there's something going on. Actually, we'll tell you before as it's happening, rather than after it's happened or in the middle of it. And that can span from anything to little niche investigations that I mentioned in one particular part of London, one particular tube station, all the way through to things like noise-induced hearing loss. And that was a trend, what was that, 5-6 years ago. The industry probably cottoned onto that a year or two too late. Actually, with this sort of technology, you can say, hang on a minute, we're seeing lots of noise-induced hearing loss. What's that all about? We'd be on the front foot in terms of the strategy, how we handle that, and what resources and what expertise we put in place to tackle that. So it has benefits away from fraud as well. And of course, with that data and insight, you can then write away if you need to from those emerging trends and threats. As I mentioned in the jewelry example, potentially you can up your rates for 14-carat jewelry until you're satisfied the risk has disappeared, or you can just come out of that market or not into that market. This real-time data gives you real insight, and it's not 12 months old or 6 months old by the time you and your actuaries are sort of looking at it and working through it. So I think that's it for me. Hopefully that's been useful. Hopefully it sort of signposts where we're going as a business in terms of the technology and the investment in counter fraud, and it's that three-legged approach. It's people, process, and technology in that perfect partnership. So thank you for your time. Julia, back to you for any questions.
Thank you, Ian. Very interesting. I think that the whole idea of counter fraud activity, I mean, it's certainly close to my heart. As you know, I came from the Insurance Fraud Bureau, so it's quite eye-opening to work inside the walls, if you like, of the IFB to know exactly what's going on and how much cost it is to not only the industry but to consumers as well. So it's a great presentation, really interesting. I have got a couple of questions for you, if you don't mind.
Yeah, go for it, of course.
So first question is there an opportunity for me as an MGA to give you non-claims data to wash through your Shift platform?
Yes, and it's something I'm keen to explore. Are we there yet? Being candid, no, we're not quite there yet. So Shift goes live for us in December. On the back of that, I'd like to explore actually once it's up and running, they're currently working through the models and scenarios. Once it's up and running, definitely we see that as a market for us, and we see that for being a real benefit for clients, the data washing piece. We don't currently have a commercial structure around that and what that might mean, but I'm keen to develop that. So yeah, whoever the question is from, if you could, Julie, maybe if you could share the details, I'll happily get in touch with anybody that's got an interest. But we definitely see that as a key part of Shift. It's not just about claims, it's about prevention as well and righting away.
Lovely, thank you for that. So my TPA could possibly be underperforming. How would I tackle this?
Really good question. So when I worked for an insurer, I worked for OSA for 20 years. Part of my role there was to actually look at TPA performance and delegated schemes and how they're performing. For me, it all starts with data. So it all starts with what's your claims volume, what's the expectation, what does the book of business look like in terms of risk, and you can start with a perception of that. You know, if all you're insuring is Tesco and Sainsbury's, clearly the risk is going to be very different to if all you're insuring is petrol stations and corner shops. The risks are very different. So what's a realistic appetite? What's a realistic expectation? What does the TPA think? What's the TPA done historically? What's the benchmark look like? Start from that point. There's lots of good data from the ABI in terms of benchmarks, and I referenced the commercial property one. 1.7% of volume should result in a fraud saving. Start from that, and if your TPA is not performing that, then get down into some of the detail and say actually what's stopping you from doing that. Is it the process? Is it your skill levels? Is it your technology? And start to work through some of that detail. But it really starts with, are they performing in line with expectation? And it is easy to sort of outside kind of kick them and say actually we think it should be 2%, we're only at 1%. Get into some of the nuances of the book and the nuances of the scheme. But also it may well be, look to yourselves as well. What sort of direction are you giving in terms of fraud? Is there a fraud strategy? If that fraud strategy doesn't exist and the expectation, well, it's literally only an expectation as opposed to a contractual term or something that's actively managed, I think there's definitely a starting point there. And it's about the active monitoring of it as well. It's about making it, you know, MGAs and TPAs are great at managing things like average claims cost, average time to contact the customer, average resolution time, all those sorts of traditional metrics. For me, and I would say this, but for me, fraud performance is just as important, if not more important, in many respects. Is that tracked monthly? If it's tracked monthly, to what level? Is it just a headline figure? Are we looking at success rates? And as I said earlier, we're also looking at how we get to that outcome. So if they are, you know, putting 50% of your customers through a fraud journey and prodding them in the chest, that's not effective. That's not a way of tackling fraud because they're probably annoying a lot of your customers and complaints are through the roof. So it's about looking at things in the round, but it starts with, for me, I mean, I could talk about this all day, but it starts with actually understanding what should they be doing, what are they doing, and then what are the things that stop them doing that, and keep your eyes open to the fact it could well be the lack of a fraud strategy or one that's sufficiently detailed and not sufficiently detailed and not monitored.
Just a final question actually from me. So if we've got, I don't know, but we might have some delegates on the line who either handle their claims themselves or they do use a TPA. So if they were to engage with Sedgwick, what would be the process in terms of next steps? So would you undertake a cost-benefit analysis, and would you look at their claims book? Would you look at perhaps the element of fraud or percentage of fraud that they're currently seeing, and could you do some kind of calculation that would potentially indicate what level of fraud they could be missing, benchmarking against other businesses?
Absolutely, yeah. Only to that, and I really like doing that because it's very easy to use a benchmark, and I gave an example earlier about, well, this is what you're potentially missing. Until you get into and under the skin of that particular scheme and that particular team and the fraud risk appetite and all those demands and all that sort of stuff, it's very difficult to come up with the size of the prize. And certainly the way we like to do business here, and the way I've always liked to do business is let's sit down, let's have a chat. What are you trying to achieve? Where are you currently, and what sits in the middle? So perfectly happy to talk to any MGA, TPA, MGA about what is the gap and what we can do to help. Definitely.
That's great. Thank you very much. I don't have any other questions, but I do thank you for the presentation today. It was really interesting, and it's interesting to see the work that you're doing with Shift Technology. And I know Sedgwick's recently also signed up to the IFB, so it's a good tri-partnership, I suppose, all round, really. So thank you again for the presentation. As I said at the top of the meeting, the slide deck will be available post-event, and the webinar will be uploaded to our website and YouTube, MGAA. So thank you all for joining. I do wish you all a very good afternoon. Ian, thank you again for your time, and hope to have you on a call again soon. Thank you very much.
Thank you. Cheers all. Bye-bye.